Today we're looking at a high-risk, high-reward analysis report, SLS stock, the 400% upside opportunity nobody is talking about.
Yep.
It's arguing for SLS Life Sciences to go from about $1.40 to $7, and it all hinges on the upcoming Phase 3 Regal trial results.
And that 400% number, that's the headline. When you have a thesis that hangs on one single event, the logic behind that $7 figure just has to be rock solid. So let's jump right in.
Okay, so the analysis kicks off with what it calls the $1 million math.
Right.
The $7 target, the 400% upside. And it does a good job explaining that the Regal trial is a binary event focused on overall survival, which is, the gold standard for FDA approval in oncology. The weakness, though, is that the connection between a successful trial and that immediate jump to $7, it's really just based on Wall Street consensus.
Right, and that just feels incomplete in a situation this volatile. The report needs to more robustly connect a positive outcome of the Regal trial directly to that $7 target to really, substantiate the 400% claim.
Exactly. Right now, that $7 number feels more like an expectation, not a derived valuation.
It's kind of like saying, this house is worth $1 million because my neighbor told me so.
Yeah, instead of this house is worth $1 million because we ran the numbers, we checked the comps, the square footage supports it.
Exactly. If the whole point is the higher reward, you have to prove that reward is mathematically sound.
So what's the suggestion here?
I think the analysis needs to introduce a sensitivity analysis, or even just a simplified calculation that bridges that gap between, say, a successful approval and the actual commercial potential of the drug. GPS?
Galimpimutses.
Right. That provides structural support for the target itself. It proves the number comes from real market metrics, not just trust.
I hear you on the back calculation, but isn't there a risk that you're just reverse engineering the consensus number? You're kind of just confirming the homework of other analysts whose assumptions might have been flawed to begin with?
That's a fair challenge, and it really gets to the core of due diligence. The goal isn't just to match the number.
Okay.
It's to ground it in economics that the reader can actually verify for themselves. The analysis correctly points out that GPS targets AML patients in second remission, where there are what?
No FDA-approved maintenance therapies. None.
Exactly. So it could become the standard of care.
And a standard of care designation, that just fundamentally changes the valuation.
It does. So the analysis should build out a scenario based on the potential market size. You could start with a conservative estimate of eligible patients, maybe estimate a penetration rate, and then you can get to peak annual sales.
And that's where the back calculation comes in.
That's where it comes in. You frame it like reaching $7 implies an X market cap. To get to that cap, analysts must be forecasting Y amount in peak sales, probably based on Z number of patients.
Right.
It forces that connection between the science, the patient group, and the financials.
That's so much more powerful because it lets the reader look at X, Y, and Z and decide for themselves if they believe it, independent of what Wall Street says.
And to really lock it in, you could benchmark that implied valuation against other successful, high-risk biotech stocks that hit their endpoints and became the standard of care in similar niches.
Ah, so you show why $7 is plausible based on precedent.
Yes, not just that analysts say so. That combination of back calculation and benchmarking, that's what creates the resilient support you need for a 400% claim.
Okay, so if we've built the structural support for the $7 ceiling, we now have to focus on the foundation.
The floor.
This whole thesis is so vulnerable to binary risk. If the Regal trial fails, the whole thing could collapse. The analysis tries to manage this by introducing the hitting gem, SLS009.
Which is a really critical opportunity here.
It notes that many analysts think the current price, around $1.40, only reflects cash on hand, and ignores the potential value of SLS009 entirely.
And that's where you have to tighten up the argument. To mitigate this perception of binary risk, the report really needs to elevate SLS009 from just a secondary catalyst to an independent, tangible part of the financial floor.
Because the weakness is clear. If Regal fails, the bear case suggests the stock drops to its cash value, which is sub 50 cents. That's a huge loss from a $1.40 entry.
A massive loss. And the analysis needs to actively push back against that as the absolute worst-case floor.
How?
It needs to assign at least a qualitative or maybe a hypothetical cash-adjusted floor value to SLS009. It's highlighted for having unprecedented survival data, a high response rate.
Right, in those venetoclax failed AML patients.
A very tough-to-treat group, so you have to leverage that asset to refine the whole downside scenario.
Just to be clear for the reader, SLS009, this is a CDK9 inhibitor. It's a totally different mechanism of action, targeting patients who've already failed the current standard treatment. That's a population with a huge unmet need.
Precisely. And the company has compelling phase 2 data from ASH. That means the market should be assigning some kind of optionality value above just the cash in the bank.
So even if Regil fails, the drop to simple cash value is maybe an oversimplification.
It's a huge oversimplification because the company still holds this high-potential drug candidate.
So if the established bear case is 50 cents, and we can argue the floor is actually, say, 75 cents or even $1 because of this other asset, that completely changes the risk-reward ratio.
It changes the entire calculus. Yes, we need a revised bear case scenario that explicitly factors this in.
Can you give a concrete example of how to integrate that?
You could create a section, revised bear case. Frame it as, if Regal fails, the stock tests 50-cent support. But the inclusion of the early-stage SLS009 value, especially with its recent phase 2 data from ASH, should place a revised floor closer to, let's say 75 cents to $1.
And you'd have to explain why that phase 2 data warrants being included in the valuation now.
Yes, even though it's early stage. And don't forget the financial runway that was mentioned.
Right, the recent raise.
The recent $29.1 million raise, that extends their cash into 2026. You have to frame that runway as the critical support that allows the company time to de-risk SLS009, completely independent of this one binary event.
So that financial security reinforces the revised floor?
It makes the argument that the stock is worth more than just its cash, even if GPS fails completely.
Okay, so we have the potential upside established, we've refined the downside floor. Now we have to talk about the big siege engine against this whole investment case.
The institutional selling.
The institutional selling pressure. The report correctly identifies it, specifically Capital Research Global investors cutting their stake by about 55%. And that's a major risk that spooks retail investors.
It's a huge red flag. When a respected institution cuts its position by more than half, that's a massive, tangible counter-argument to the whole thesis.
And the report's treatment of it is, well, it's observational. It just states the fact.
Exactly. It's not analytical. It needs deeper context to really neutralize that counter-argument effectively.
I agree. I mean, just saying a big fund sold off 55% of its shares, it leaves the reader thinking, well, they must know something I don't.
And that doubt, it just undermines the whole opportunity nobody is talking about idea.
It does.
If this analysis is going to be taken seriously as a speculative buy, it has to proactively investigate that exit. It has to try and neutralize it. It shows superior due diligence.
But how do you investigate the internal decisions of a huge institutional fund? Their reasons are almost always private.
You're right, the exact reason is probably unknowable. But the analysis can integrate potential, plausible explanations for that 55% reduction.
Okay, like what?
Well, was it a forced sale because of a fund mandate? Maybe their charter says they have to sell stocks that fall below a certain market cap. Was it just simple tax loss harvesting near the end of the year, totally unrelated to the science? Just listing those alternative explanations provides a narrative counterweight.
So it counters the immediate conclusion that the institution is running scared from the science.
Yes, and you can use the company's own timeline to neutralize the risk even further. The analysis mentions that positive interim data from early 2025.
Right, the recommendation to continue the trial.
That's your pivot point. If you can't know the internal reason for the sale, you can at least compare the selling timeline to known events. The writer should ask, did the fund exit before or after that positive interim data?
Ah, okay.
Because if they sold after the good data came out, it strengthens the argument that the selling was driven by non-fundamental things, like portfolio rules, not an insider view that the trial is going to fail.
That's a really sophisticated layer of analysis. It separates the technical selling event from the scientific outcome. It suggests the exit was a matter of policy, not a lack of conviction.
Precisely. And one last thing to tie it all together.
Go on.
Link the technical chart pattern, the lower highs and lower lows, not just to general sentiment, but link it directly back to the volume created by that one single massive institutional sale.
So you frame the technical weakness as a consequence of that specific event.
You frame it as a known event, not some generalized lack of confidence. It turns the technical chart into a consequence of known selling pressure, which theoretically should go away once that fund is done selling.
That turns the bear argument from a fundamental fear into an explainable and maybe transient technical drag. That's a massive improvement.
This was a really compelling analysis report. It sets a huge target, and I think we've focused on 3 core areas to just maximize its robustness so it can withstand some real professional scrutiny.
Right. So first we need to solidify the upside. That means establishing a clearer structural and quantitative link between a successful Regal trial and that $7 target. Don't just rely on consensus. Show the back-calculated math.
Second, fortify the downside. Integrate SLS 009 as a tangible component of the downside floor valuation to better manage that binary risk perception. Use the Phase 2 data, use the 2026 runway to really refine that low-end price target above the simple cash floor.
And third, neutralize the biggest counterargument. Provide deeper analytical context around that institutional selling. Look at the why. Was it a mandate or was it a fundamental concern? Don't just observe the what.
Yeah, the material makes a really exciting case for a high reward.